Okay, so you can get your mortgage insurance removed earlier than anticipated. However, how so may be partially based on the investor that Fannie Mae or Freddie Mac sends the loan to after closing. All right, this might be confusing, but only after closing, say 30 to 45 days afterwards, is this investor decided. And at that point, you can then go and call servicing and figure out the exact rules for how your mortgage insurance can get removed. Now for FHA loans, the mortgage insurance never comes off. It's not eligible. And on conventional loans, there's a 2-year minimum time requirement before the mortgage insurance is eligible to come off. Okay, now what decides when you can take it off is the loan to value of the home ratio. Okay, so here's the big part, so pay attention. To get this ratio, you divide the current loan balance by the home value, and you want that to be 80% or lower of the home value to have it removed. And don't be confused, the way the lender decides your home value is by taking the lower of either the original sale price or the appraisal value. Okay, so for example, if your home appraised at 510, but you bought the home for 500, then 500 is going to be used for the home value. Okay, so once your loan balance is paid down to reach 80% of that original value, you can call the servicing hotline and request that it be taken off. I know, you do have to call and ask, that is weird, right? But then once the balance reaches 78% of the home value, it will automatically come off. And you don't have to call the servicer for that. Now, let's say you don't agree with the value of the home that the lender is using for this ratio. Let's say you think it's an outdated value and that the home value has increased, gone up substantially since the time you bought your house. Well, if the investor allows it, you might be able to get an appraiser to come out and reappraise the house and then use that updated value for the loan to value ratio. Okay, so let's say if you bought at 500 and now the home is worth 550, that could very well put your current mortgage balance under the 80% loan to value ratio. Okay, now you'd probably have to pay for that new appraisal, but if your PMI wouldn't come off for another 2 or 3 years without it, and it could save you hundreds or thousands of dollars to get that off, then you'd want to pay that appraisal fee to get that off. But again, it doesn't hurt to just call servicing and ask them what the rules are. So there you have it. Thanks for watching, and if you learned something, do yourself a favor, go subscribe to the channel. There's a lot more useful information that I have here for you.